Math for real estate. That's what we are reviewing tonight. And we're continuing from last night's session. We are doing investment tonight. So get ready. You're learning everything about math to make sure you get all your math problems correct in the live real estate exam, right? Okay, so this is the book. And actually, my thumbnail has the book cover on there in case you want to purchase it and follow along, either with my lives or all the other videos that we've recorded. Okay, so let's get with doing the review. So we're doing investment. So any questions before we start? Anytime you have questions, post them in the chat comments or after the class is ended, and I'll answer any of your questions. All right, so investment, appreciation calculations. So when you're in real estate and you start doing excellent, start doing great, don't have to necessarily do excellent. You start making money in real estate. You can consider to start investing in buying either rentals, properties to rent out, fixer-uppers. Many people focus on fixer-uppers. I do not. It's a lot of work, takes time, versus getting something that's already in good condition, maybe needs some finer paint, flooring. Those are cosmetic things. And it's quicker to get them back on the market to rent. As long as you're making minimum 200, 300 profit per month, you've got a good investment where the borrower is going to be paying, the tenant's going to be paying your mortgage if you have a mortgage on it. All right. So hopefully you will do some of that, invest in real estate when you're making money. I did that until just a few years ago. Sold all my my assets in real estate. Okay, appreciation calculations. Simple appreciation formulas. Total appreciation equals the current value minus the original value. So most properties increase in value except when there's a downturn on the market or we have a bad economy and prices start to drop. However, markets go up and down in real estate, in the stock market, grocery, cars, they go up, but they gradually keep increasing, going up. Real estate is one of the best or the best investment because it's solid. You can touch it. Versus stocks, and I've done both. Okay, so the current value, so let's say you bought a home 5 years ago, 10 years ago. So the current value is what's today's market value. You can do it through a comparable or through an appraisal, minus the original price when it was purchased. Total appreciation rate is you have the total appreciation, that's the current value minus the original value, divided by the original price. Oops, sorry. The average annual appreciation rate is the total appreciation rate divided by the number of years, because it can appreciate every single year. So if the property appreciates as a tax shelter, a tax write-off, we also have the tax depreciation write-off. Okay, so there's multiple ways to make money in real estate. So tax total appreciation rate, that's a number, is the total appreciation, okay, current value minus the original value when it was bought, divide by the original price. Average annual appreciation rate. So now we have the rate up here divided by the number of years that someone has had the property. So 1 year appreciation rate is the annual appreciation amount value at beginning of the year, the beginning of that year. So if it was bought in 2010 and we're currently doing an appreciation for now, it would be the 1 year appreciation rate and the annual appreciation amount. So let's say it appreciated 5,000 in the last year. And then you put the value at the beginning of that year, which would be right now 2026, right? And it was bought in, what did I say, 2005 or 2010. So an example, a home purchased for 200,000 5 years ago. How many years? 5 years ago. Pay attention to that. Is worth now, that is in today's market, 300,000. So they bought it for 200,000 5 years ago, and now it is worth in 2026 300,000. What are the total appreciation amount, total appreciation rate, and average appreciation rate? So what is the appreciation rate average amongst all the years? So total appreciation, right? We start out with the original, current value minus the original value from 5 years ago. So 300 minus 200,000 equals 100,000. So that's the appreciation. The total appreciation rate, okay, we're now taking the difference of the appreciation from the original price and current value, and we're dividing that by the 200,000, the current value, or 50%, right? 100 divided by 200,000, it's 50%. An average annual appreciation rate equals 50% divided by 5 years equals 10%. So in the 5 years, it appreciated 100,000. So then we're looking at 100,000 divided by the original value of 200,000 gives us 50%. It's increased 50%, right? 100,000. The average appreciation rate per year, okay, annual, is 50,000 divided by 5 years, because we're talking about 5 years. So that equals 10%. So each year it's been appreciating 10%. That's awesome. Number 2, a home costing 250,000 is worth 268,000 1 year later. Right? So that's an 18,000 increase in 1 year. What is the 1 year appreciation rate? So 1 year appreciation rate is the difference of the original price and the current price, original, current, divided by the original price. So that's a 7.2% average, rate for that 1 year. So the 18% increase is equivalent to 7.2% increase in 12 months. So compounded appreciation. So compounded appreciation, it keeps adding up, right? You add the appreciation to the previous value, and then it appreciates again. You add that. So it is appreciated value equals the beginning value times 1 plus annual rate times 1 plus annual rate, because every year it's increasing, it's 1 times the annual rate before, for the number of years in question. So this is how compounding interest, when you have an account and you've got money in there for compounding an annuity or money market or anything else where you leave the money there. So it keeps increasing. It compounds every year. The interest gets added to the original value, and now that has a new amount of interest for that year, and you keep adding it and so on and so forth. So an example is a $1 million property. They love to use $1 million properties, right? Yesterday we had 7 million, 1 million. So a 1 million property is expected to appreciate how much? 5% each year for the next 3 years. So how much is it appreciating? 5%. For how many years? The next 3 years. Pay attention to those numbers. What will be its appreciated value at the end of that period? Okay, at the end of the 3 years. So we have 1 million, the original value, times 1 plus 0.05. So 1 plus the 5% increase, that's 1.05, times 1.05 again, times 1.05. And why do they do it 3 times? Because it says 3 years. So they're using the above 1 plus annual rate 3 times. So that gives us an appreciated value of 1,157,625. So it appreciated in 3 years 157,625. So more than 10%, right? Because 100,000 would be 10% of 1 million. So the rate of return, investment value, and income. So rate of return, ROR, investment value, and what's the income they're getting. So the investment value is the original value. So formulas where income equals net operating income. So that is the income after subtracting all the expenses, all the operating expenses. So that's NOI. We did that on the video yesterday. Net operating income. So you can look at that video. Rate equals rate of return, the cap rate, or percent yield, and value equals value, price or investment amount. So rate equals income divided by the value, right? We're getting a percentage. And value equals, they're just rewriting this formula, solving for a different factor. So value equals income divided by rate. So they move the value to the other side of the equation, and the rate came in place of value. Okay, so value equals income divided by rate. And the third way to write this formula, solving for income, is income equals the value, current value, times the rate. Okay, so same formula written 3 different ways, solving for 3 different factors, the 3 factors in that equation. So examples. An office building has 200,000 net income and sold for 3,200,000. What was the rate of return? Okay, so we're looking for rate, right? So we're using that formula. So rate equals 200,000. So that's an office building has a 200,000 net income after expenses, divided by 3,200,000, the price that it was sold for. So what was the rate? The cap rate, 6.25%. Okay, so so they use the division single here with a line and 2 lines instead of doing it this way. But you're looking for rate. It's the same thing. Income divided by value, either with a line across it or the little division sign with 2 dots in the line. Number 2, an office building has $200,000 of net income and a cap rate of 625. What is the value? So we're using this one, right? Looking for the value. So the value equals 200,000 divided by the rate, convert that to decimal, 0.0625, equals 3,200,000. So investors look at this when they're purchasing property, and so did I when I purchased an apartment complex. Number 3, an office building sells for $3,200,000 at a cap rate of 6.25. What is its NOI? So, So we have the, what do we have? Sells for $3,200,000 and has a cap rate of 6.25. What is the net operating income? So what is the income? Value times the 6.25 will give us the income. So the NOI is 3,200,000 times 0.0625, also 6.25% equals 200,000. So this formula, written in 3 different ways, solving for a different factor. Hey, MJ, thanks for joining us. Sorry, I just saw you. And you can solve backwards, okay, to make sure you got it right. And when I say backwards is if you solve this right here, then try to solve a different equation, value, this and this. It's checking your work. Very common in math to check your work by using the same values, the same amounts in a different written formula. Same formula, just solving for a different factor. Okay, basis, adjusted basis, and capital gain. So basis is the original price. Adjusted basis is if you added a 3rd bedroom and a garage, then the basis of that home changes because now you have a garage and a bedroom added to it. And then the capital gain. How much was gained from the time it was purchased till the time it was sold. Formulas. Capital gain equals amount realized, the profit they made, minus adjusted basis, where amount realized equals the sales price, okay, the original price, minus the selling cost. Selling cost, right? What is the cost of selling real estate? Clients will ask us that. So how much is it going to cost me to sell my property, my land, my building, my house? Adjusted basis is the beginning basis when the property was purchased, the original value, plus the improvements, the garage and the bedroom, minus total depreciation, right? Because that property is depreciating every year. So that has to be subtracted. In the exam, you might think, oh, okay, all I need is beginning basis plus capital improvements. Well, no, because now you forgot the total depreciation. That has to be taken into account. So the total depreciation equals beginning depreciable basis, okay? The beginning value, the original basis, okay? Beginning basis there, divided by depreciable terms. See how many years they're going to do it. Term, depreciable term, how many years? Times the years depreciated. So depreciable basis equals your initial property value when they bought it, plus the bedroom and the garage, minus the value of the land. Remember yesterday I said land does not depreciate. It's not taken into account as depreciating because land is land. The improvement, the land was there before the home and the improvements were built. The land is the same, built afterwards. Now, if you're close to the coast, by a river, a creek, and you have erosion, yeah, you might lose a little land, but or increase a little bit of land, but the land is still there. It's the same. It's not something that deteriorates by the year because of wear and tear and age. So an example tip, work example backwards from last formula to first formula. Oops, pardon me. From last formula, okay, to the first formula. So an apartment building was purchased for $500,000 with the land value estimated to be $100,000. The owner, so the land is what, 20% of the property, or 1/5, right? The owner added a $100,000 parking lot. So that increases the value. That changes the basis from the original $500,000. The property was depreciated on a 40-year schedule. I mean, it kept depreciating 1/40th every year for 40 years for present purposes. 3 years later, the property sold for $700,000 and selling costs were $50,000. So the cost of sale was $50,000, right? Commission, closing costs, title costs, any repairs, whatever was done. What was the capital gain? So how much profit did they gain in how many years? 3 years, while it depreciates 1/40th every year. So depreciable basis, the original value, $500,000 purchase price, plus the parking lot, $100,000 parking lot, minus the land, okay, equals $500,000. So the parking lot and the land cancel out. So you end up again with $500,000. Now total depreciation equals $500,000 divided by 40 years. Right? Because it has a 40-year schedule depreciation times 3 years. They kept it for 3 years. That equals to $37,500. So every year it depreciated, and a total of 3 years was $37,500. The number 3, the adjusted basis equals $500,000 purchase price plus $100,000 parking lot minus the depreciation of the 3 years. So that equals to $562,500. So you don't take the land into account when dealing with the adjusted basis. The basis was the original price by the parking lot, and then the 3 years of depreciation that is subtracted. So they came out with $562,500 as the new basis. The total amount realized when they sold it for $700,000 sale price minus the $50,000 cost of sale, right, to get it with a realtor and get it closed, it came out to $650,000. So later, 3 years. The other stuff is to confuse us. Yes, correct. Yes, MJ says the other stuff is to confuse us. Yeah, the exam is there to confuse you, okay? So when you learn the material, you're better off than by memorizing it. Okay, so they realized $650,000. The capital gain was $650,000, their amount realized, minus the adjusted value, which was $562,500, right after they subtracted the depreciation, equals $87,500. So that's what they gained in 3 years after adding the parking lot and depreciating it for 3 years. So from $500,000, it came down to selling 3 years later at 87,500. So it's multiple steps, okay, to get to this property. First, you have to find out what the total depreciation was. To do that, you're taking the purchase price plus the parking lot minus the land. So it comes out again to 500,000. The second step is divided by the 40-year schedule times 3 years. So you can get the answer for 500,000 divided by 40 and then multiply that by 3 in 2 different steps, or do it in one like they did here. So you've got depreciable basis, the total depreciation for 3 years. Now we want to know what the adjusted basis is today. 500,000 purchase price plus 100,000 parking lot minus 3 years of depreciation equals 562,500. Don't include the land here. That was already included when calculating the depreciable basis. So the fact that it's the same amount, 500 and 500, that's only because we had 100,000 parking lot and minus 100,000 for the land. It's not always going to be that way in the real exam. So you've got the adjusted basis. The beginning value minus improvements minus depreciation gives us a new value. So then what is the amount that they profited, that they realized? Well, 700,000 minus the cost of sale, 50,000 with a realtor or broker, equals 650,000. And now we have to subtract, we have to deal with the capital gain. So 650,000 is the amount realized minus the 562 adjusted basis, right? Gives us a profit of 87,500. So in 3 years, out of a $500,000 purchase, they got 87,500. But then they added a parking lot, right? But then they get a write-off of I'm sorry, never mind. And they sold it for 700,000, 100,000 more, but then selling cost and then the adjusted basis, which was deducting the land and adding the parking lot. Okay, depreciation formulas. Formulas. Depreciation formula. Annual depreciation equals beginning depreciable basis divided by depreciation term, the number of years. Yesterday I mentioned that my particular complex or some of my rentals got depreciated for 27 years. I didn't own them for 27 years, but my accountant would depreciate it 1/27th each year. Okay, so the depreciable basis, initial property value, any capital improvements minus what? Minus the land. That's only used to calculate the depreciable basis. What is the value that the accountant is going to depreciate each year? They've got to subtract the land because land is not depreciable. Hope you remember that all those times I repeat it. So an example here, the property value is 500,000. The land value is 110,000. And the depreciation schedule term is 39 years. So let's calculate it. So 500,000 minus 110,000. What? At the land. So how much of that property? It's only the improvements that get depreciated. So the improvements are valued at 390,000. That's the basis that will be depreciated by the accountant that is allowable by IRS. So then 390,000, because we're still looking for the depreciable, I'm sorry, not depreciable. We're looking for the annual depreciation, right? So 390,000 divided by how many years? 39 years is what the question said, equals 10,000 annual depreciation. So each year, that property will depreciate 10,000. In 10 years, it depreciates 390,000. So there's no more value on the improvements for the investor to keep it if they want to have a tax shelter of depreciation. So they may sell it, or they may just continue collecting rent and not have a depreciable amount. Most investors, most companies want to be able to gain that depreciation every year. Okay, equity. What is equity? So does anybody know what equity is? Well, you don't have to guess. Formula is right there. Equity equals the current value minus the current loan balance. So every month that we're paying on that mortgage, the principal reduces. So the equity increases. That's the part we already own. We've paid down. So an example, a home that was purchased for $150,000 with a $100,000 loan is now worth $300,000. So to begin with, they already had $50,000 of equity, right? Because they put $50,000 down. So that is considered equity. So, and then it's now worth $300,000. So it's worth twice what they purchased it for. The current loan balance is $80,000. So so they've paid a lot of money down, right? So they paid $50,000, brought it down to $100,000. Now it's worth $300,000, but the loan balance is $80,000. So what is the current market value? So they increased their equity by making payments and their down payment, and the property value appreciated. So that's a big plus. They gained equity in two directions, making payments and down payment, and the market value increasing. So equity is $300,000 value minus $80,000 debt equals $220,000. So the property is now worth $300,000, right? The current loan balance is $80,000. What is the equity? $220,000. Now, do you really need the $150,000 and the $100,000? No. Okay, because they're telling you, what is it worth today? And their loan balance is $80,000. So you don't need the first two numbers. That's there to confuse you. So they're telling us, hey, it's worth $300,000 today, and the loan balance is $80,000. That's all we need to find out what the current equity is. $300,000 today's market value minus the $80,000 mortgage loan debt that is still owed. They have $220,000 equity. They can now go and get a home equity loan, do improvements to that property, or use them to pay down debt. It's always best to keep your equity and not use the equity to invest in other property. Use OPM, other people's money, to invest. OPM, other people's money, instead of using the equity on your own home. You want to protect your own private home, okay? Because it can be really easy to lose it if we make mistakes with our investments. All right, net income. Right, income minus operating expenses equals net income. Potential net operating income equals potential rent minus the vacancy loss right? They don't have 100% rental, so you have to deduct the cost of having certain units vacant, plus other income, which could be a vending machine, could be a laundromat, washer and dryer machine, things like that, minus operating expenses. So vacancy loss is deducted. That's from units that are vacant. Operating expenses is maintenance, to the property, repairs, gardener, property management, all those things, okay, are operating expenses. Utilities, if they're paid by the owner, if they're paid by the tenant, they don't have to worry about utilities. So note, NOI does not include debt payments. Debt payments, the mortgage, it does not include that. The operating expenses also includes property taxes, because that's a yearly expense that has to be paid on that property. We never own the land 100% because we always have to pay property taxes unless it's 100% disabled veteran. 100% disabled veteran is exempt from paying property taxes. Just for your information, FYI. Example, a building has 10 office suites, generating annual potential rent of $10,000 each. So 10 suites times 10,000 equals what? 100,000, right? Now they have a vacancy of 10% and annual expenses of 35,000. Vending machines yield 5,000. What is the NOI? So we have 100,000 minus the 10,000 for the vacancy. They have one vacant unit, 10%. Oh, and then we subtract the annual expenses. However, yes, net operating expenses. So we're looking here per year. What is the NOI? 100,000 rent minus 10,000 vacancy. They have one vacant plus 5,000 other income from the vending machine, washer and dryer. What else did I say? I forget. 35,000 expenses. That gives them a net operating income of 60,000. Any questions? Gee, I've got to look at the. I've got to look at when somebody answers. What did you do? Where's the 220,000? What was the answer? Oh, yeah. Very, very good. MJ got that one right. Yes, I've got to pay attention. Most of the times, all of you are not participating, so I have to pay attention to that. Every now and then you do participate. Okay, so 100,000 was the rent that they get. A building has 10,000 office, 10,000, 10 office suites generating annual. What kind of potential income? Annual. Okay, not monthly, but annual of 10,000 each. Vacancy, 10%, so that'll be 10,000. The annual, again, expenses for all 12 months are 35,000. The vending machine yield, maybe washer and dryer, anything like that, they gain 5,000. Their NOI is then 100,000 rent minus 10,000 for one vacancy plus 5,000 other income minus 35,000 expenses, operating expenses, equals 60,000 net operating income. So that's how much they're making each year after all expenses. So cash flow, money coming in, more money, get me more money. I want investments that bring me money. So cash flow, the internet, well, the internet, MJ, that's typically paid by the resident unless it's a big, unless it's a big office building where the internet is being provided by the owner, but typically the internet is provided by the individual. Okay, cash flow formula. Cash flow is how much money they're cashing in every month. equals net operating income minus their debt service, where their debt service is PI, principal and interest. Okay, so here they are including, because this is for cash flow, because every month they have to pay principal and interest, okay, and they're getting money coming in every month. So net operating income minus debt service, where debt service is PI. Taxes and insurance was already included, on operating expenses. So an example, a building generates 100,000 net operating income after expenses and has a debt payment of 40,000. What is its cash flow? So is it monthly or is it annually? So cash flow equals 100,000 minus 40,000 equals 600,000. Okay, so the cash flow they're getting here, a building generates 100,000 net operating income, and that could be monthly. So what is their monthly cash flow? 60,000. That's pretty good. Investment property income tax liability. Formula. Any questions? No, I don't see any. Tax liability equals net operating income divided by the reserves minus interest expense minus depreciation times their tax bracket. So how much taxes are they paying on that income received from that investment? Tax liability to IRS, Uncle Sam, equals net operating income plus any reserves that they have minus the interest expense minus depreciation. Okay, those are write-offs, tax shelters. They can write off the interest of the loan and the depreciation times their tax bracket. Example, an office building has net operating income of 200,000, an annual reserve expense of 20,000, interest expense of 130,000, and annual depreciation of 50,000. Okay, this is annual. Interest expense is annual depreciation. Assuming a 28% tax bracket, what is its income tax liability? Okay, so going to the formula, net operating income. Let me reduce this, see if I can get it all in one page. Okay, so here, cash flow, net operating income minus debt service, where debt service is PI. Oh, that's not it. Tax liability. So an office building has NOI of 200,000, an annual reserve expense of 20,000, interest expense of 130,000, and annual depreciation of 50,000. Assuming a 28% tax bracket, what is the income tax liability that that investor has to pay to IRS? So 200,000, because that was the net operating income, NOI, plus a 20,000 reserve that they have, minus the interest write-off, 130,000, minus the annual depreciation, 50,000. They add and subtract all that times the 28% tax bracket. Their liability to IRS is 11,200. Okay, 11,200. Thank you. It helps having the formula on one page. Yes, it ends up making it a little bit smaller However, it does help. I agree. Thank you, MJ. And I forgot your name. I keep calling you MJ. In fact, my cat's name is MJ, MJ Morris. Okay, now we're going to go to net return. Return on investment. Let me see here. Oh, that was better there. Okay, return on investment is ROI. So NOI, net operating income. ROI, return on investment. That's what investors want. They want to know what kind of return on their money they're going to get, right? Make more money. Example, an investment property generates a cash flow of $100,000 and appraises for $1,500,000. What is the owner's return on investment? So it appraises currently $1,500,000 and it has a cash flow of $100,000. What is the owner's return on investment? So we're taking the current value divided into the profit cash flow of 100,000. So 100,000 divided by 1,500,000, 1.5 million equals a percentage, the ROI, 6.67%. So when you divide a small number by a larger number, you're going to get a real small number. Okay, remember that. When there's a small number on top, large number on the bottom, you're going to get a small result. So 6.67% is their return on investment for that property that appraises for 1.5 million and they have $100,000 coming in. Return on equity, ROE, return on equity. Cash flow, you want to know those acronyms? Sometimes they will ask you what an acronym stands for. NOI, ROI, ROE. And you'll need to know what they are. And they might give you an return on environment. You know, they'll throw out some crazy results, right? Return of whatever, okay? They'll throw out some other words to trick you. So an example here, an investment property generates a cash flow of 100,000. The owner has 500,000 equity in the property. So the equity is what? Is the gain that they've had in the property by the market price increasing and the property depreciating. I'm sorry, cancel that. So it's the property value appreciating every year. And then also their equity on that property, every time they make a mortgage payment, their equity, because their loan amount reduces, right? So their loan amount keeps reducing, their market value hopefully keeps increasing. What is the owner's return on their equity? So return on equity is 100,000 is their cash flow. And the owner has 500,000. So 100,000 divided by 500,000 equals 20%. So they have 20% equity, return on their equity. ROE, return on their equity. So cash flow, what they're bringing in per year, divided by the equity that they have. Okay, nice. Yes, nice. I agree. You know, this is great for me also because it refreshes my own memory because I don't typically use this. If I was an investor, I would be using this like I used to. Right now, I'm not. However, we may have clients that are interested in investments. So that is the end of that section. I'm working on doing one section at a time. another day. Questions. Questions, questions, questions. If no questions, I appreciate you being here. I love doing this. I love helping you, and I learn at the same time. And should you ever see that I stated something wrong and I didn't catch myself, luckily I did catch myself several times today. Make sure you point it out. Don't be shy. Don't be embarrassed about correcting the teachers. We're all individuals and we can make mistakes. Just like I think yesterday, the day before, the book had a mistake mixing what was it? Gross rent multiplier versus gross income multiplier. They used the wrong terms. Can you go to 6 to 8 in the future? Well, it depends on how much. Yes, I can, but it depends on how much I'm going to cover, and I don't want to make it too confusing with too much information. When I do vocabulary or I do questions, yes, I have a tendency to go for an hour and a half, 2 hours. And that helps a lot because I go more explanation with the questions by explaining the question, pointing out words that you should pay attention to that could screw you up. And then the answer, letting you know, hey, delete these two. They have nothing to do with this topic. And now you have 2 of them. If you don't know the answer, then you can guess. You narrow it down. And I point out words like must, always, never, because nothing is absolute. It's very rare that something is absolute, except for we have to use our state particular contracts. That's absolute. Except when the client wants to use their attorney, then there are exceptions. Yes. So tonight, this way you can go back to the videos. Last night I did 4 different topics, and I may end up dividing those videos to have one topic of math per video. And tonight we just did investment. I think on Monday, Tuesday, we did basic math. Yesterday, we did 4 different ones. Okay, so I want to focus on one thing at a time when it comes to math. Too much math information is going to get you confused in one session. Like yesterday, we did leases, contracts for sale, appraisal and value, and then finance. It's all great information. However, if math is a struggling point, get one topic at a time. You might study 2 or 3 times in a day, or study every day. Have an excellent schedule where you have, I should share the screen. Okay, so I was talking, Tuesday we did basic math. Yesterday we did leases, contracts for sale, appraisal, value, and finance. That's a lot of information. Today we did investment. Okay. If I do a class on Saturday, then I'll do taxation. Okay. Study every day if you're getting ready to take the exam. Don't wait till just a week before the exam. And take the exam as soon as you can, especially after you finish all your courses. Everything is fresh on your mind. Take the exam, take away the fear factor, and just do it. Once you take the exam that time, if for some reason you were not to pass, then you can think of what you have to go back and study. Not think of. You can go back and know what you have to study and what you have to prepare for the next exam, and start studying those topics that you've confused you on the exam, because they're designed to do that. They want us to use our mind to think, solve problems, because as realtors, we are problem solvers. We're to find solutions for our client. Sometimes there's multiple solutions, and we've got to research and think about it and, analyze and whatever. Okay, so they want us to use our brain. So I'll be here at noon this Saturday if you want to do a session. Hey, MJ, you're really working me, but you know what? I really enjoy it. So I'll work towards that. And then he says, I have to study contracts, math, and agency. Yes. Oh my gosh. There are two. You said North Dakota, right? So I don't know how many agency courses you have here in Texas. We have two courses of principles, and they go over a lot of agency. And if so, MJ, in your state, yes, you're in North Dakota. Do you take two exams, the national and the state? Here in Texas, we take national and state. Some states have all the exams combined into one. So the good thing about here in the states that have two separate exams, if we fail the national, all we do is repeat one course and retake the national. If we fail the Texas, repeat one course and retake the Texas. If we fail both, repeat two courses that we've already taken and take both exams again. And there was a time where we could take the exam as many times as possible. I've had students when I first started this 5 times, and other students many times without having to take a course. That was changed, and it's here in Texas, and now it's 3 exam attempts, and then if don't pass, then retake courses. Okay, so contracts 9 out of 19, agency 6 out of 13, and real estate math 2 out of 7. Oh yes, focus on those. What I recommend is that you review a lot of questions having to do with those topics. If you don't have a book, I had an old book, and it would point out, it had it's one of my old videos. It's an old book, but it was excellent because it would let you know which question pertained to what chapters or what content. Most books nowadays, they don't do that. And so it's good because that way you can go and practice the same questions over on the material that you did week on. Like you said, contracts, agency, and real estate math. In the meantime that you do that, keep studying vocabulary, because sometimes you'll miss the question because of lack of vocabulary, especially in agency or in contracts. Math, it's learning the how to solve problems, learning the acronyms, because sometimes you may not have to solve a problem. It could be an acronym. My scores from previous tests. Yeah, I got you. Understood that. So I greatly appreciate you sharing with us, MJ. That's so good. I'll tell my cat, MJ Morris, that I met an MJ from North Dakota. Okay. So I'm trying to see which section. Let me see on this book. Let me share my screen again. Okay, so on this book, see, you have, so all the reviews, rights, interest in estates, ownership, okay, agency. So there's a whole section on agency, right? And then you look for questions that pertain to agency. And actually, you know what? You can you can ask ChatGPT to create some agency questions for you. And you can Google it online or on YouTube and say agency questions. Okay, for those are national. And you'll end up seeing questions about agency. And then you said math. Okay, well, we're doing math. And then contracts. So there's contract law that is national, the same for all states, right? And then there's sale contracts, the purchase and sale contract. And then when it comes to then you have contracts for sale. So there's more contracts. That's in the math section. And then under Texas, we have contracts, which you have a whole also section that deals with contracts for your state. Another place to find questions is in your real estate commission. Our Texas Real Estate Commission, you can go in there and search frequently asked questions. They have a section per topic of lots of questions. So MJ, check your state commission. Go in there and search for real estate questions, frequently asked questions. And there are questions that have to do with the exam, with the topics of in your particular state, including national. A lot of times students forget to go to their own real estate commission and look up questions there. There's now, with so much online, there's so many resources to also look up, but sometimes we may still not understand. So continue studying. I'll let you know whether I do Saturday. You'll see my posting for Saturday. I have different messenger groups where I add people to them, but I need to know your messenger handle or your Facebook handle so that I can add you to different groups that I have. For example, let me show you. Hold on. I'm looking up Facebook. So let me show you what I'm talking about when I say that I have messenger groups. Let me share the screen. For years. So under Facebook Messenger, if I type RE exam, it's working. See on the bottom. Okay. You see how I have 5 different groups where I have lots of students from the past and current. And so I send a reminder on this group. So National, Rio Grande Valley, South Texas, Agent Prep when I ran out on something else, San Antonio, and Texas. I tried to add you on Facebook. I think you have to request for me to be a friend. It depends. Maybe I didn't know. I didn't know what your handle is. So what is your Facebook name? MJ? Is it MJ Smith? You just did. Okay, so let's see here. And sometimes, Max Smith. Let's see. So you just requested, confirm request. That one's your digital creator. I sent you a friend request. Okay. So I got it. So now I can add you to my national group. So we are now friends. Okay. So I can go to my national group here and add, see Max. Let's see here. Members. It takes time to do all this. Okay, no, I need to add. Okay, I'll do it later because I need, I'm trying to figure out, I keep forgetting. It's harder to do it when it's in a small screen like that. But I will add you to this group. Let's see here. Add people right there. So Max Smith, that's you right there, right? Max Smith. So you're now in that group. So whenever I post on here after I schedule the class, then I send this out. And that way you'll get a reminder. I also, it shows up on YouTube, and I also put it on my Facebook, Lillie Handy Agent Prep. It used to be Agent Prep. All right. So enough of that said. We've been here an hour and 5 minutes. I thank you so much for that. And I appreciate your attendance. If you haven't subscribed to my channel, I ask it politely. So, hey, click the subscribe button, the thumbs up, write a comment, and click the bell so you get notified anytime that I go live or I prepare to go live. You'll get an alert. But I appreciate it. You're very welcome. And MJ, yes, and I'm going to eat late. I'm going to eat. So have a good night. Enjoy. Keep studying. And until next time, catch you later. Bye. Oh, this is Lillie Handy Dominguez with Agent Prep coming to you from San Antonio, Texas. Until next time.